Okay, welcome back from the break to our program on corporate inversions. It's rare that a technical tax matter finds itself at the center of mainstream news media in the way that corporate inversions have in the recent past. President Obama recently referred to prospective inverters as corporate deserters and called for economic patriotism from those companies. The strategy of corporate inversions is not new, although it had not occurred at such a frequent pace until recently. Our next panel will discuss the phenomenon of corporate inversions and whether the recent flurry of activity in this area is perhaps a symptom that the U.S. international tax system is in fact broken. The panel will be chaired by Deborah Paul, and panelists include Patrick Jackman and Professors John Steines and Willard Taylor. From your left to right, Deborah Paul is a tax partner at Wachtell, Lipton, Rosen & Katz, where she focuses on the tax aspects of corporate transactions, including mergers and acquisitions, joint ventures, spin-offs, and financial instruments. Debbie Paul is a frequent speaker at the Practicing Law Institute, American Bar Association, the New York State Bar, New York City Bar, and the International Tax Institute on various aspects of corporate taxation. Pat Jackman is an international tax principal at KPMG's Washington National Tax Office, where he specializes in cross-border international corporate acquisitions, mergers, internal restructurings, business formations, and joint ventures. Pat is a frequent speaker, writer, and is co-author of the leading M&A tax treatise, U.S. Taxation of International Mergers, Acquisitions, and Joint Ventures. Professor John Steines teaches several tax classes at NYU Law School, including those on international tax. John frequently testifies as an expert in tax-related controversies. A former editor-in-chief of the Tax Law Review, his scholarship includes a casebook called International Aspects of U.S. Income Taxation. Professor Steines served as the sole author of the most famous Bitger and Eustace treatise on federal income taxation of corporations and shareholders from 2011 through 2013. Willard Taylor was a partner with Sullivan and Cromwell for 35 years and remains of counsel to the firm. Willard is a former chairman of the tax section of the New York State Bar Association and is an adjunct professor at NYU Tax LLM program. Debbie, over to you.
Thank you very much. Well, we are delighted to be here to talk about inversions this morning. Now, inversions are a topic where much ink has been spilled, much has been said about them, but Larry has helpfully given us a focus for our conversation, which is whether inversions by U.S. multinationals constitute voting by your feet for a territorial tax system. Now, that's kind of a loaded question. Voting with your feet suggests that there's something wrong with the U.S. system and that other regimes are more hospitable to businesses and that the U.S. should really take note of this. This is an alarm, this is a symptom, as Larry said, and that the U.S. really ought to align itself with other regimes that are more business friendly. And we'll talk about that, or whether perhaps inversions are a fad, maybe a cyclical fad, but nonetheless a fad that shouldn't drive tax policy and the design of our tax system. And also another theme is whether if we do move to a territorial system, can we appropriately allocate the tax burden among businesses in a way where they are paying for what they get out of the U.S. system with all the economic, cultural, social, legal, and other factors that help foster business in this country. So those are some of the broad themes inherent in this topic. Now, let's just say a word about what a territorial system is. A territorial system is generally a system that taxes only income that is sourced in that jurisdiction. It's in contrast with a worldwide system that taxes a taxpayer on income it earns no matter what source that income is from. Now, in the US, we're generally thought to have a worldwide system for taxing businesses, and it is, but it's a system that reflects an understanding or a compromise that was reached on the order of 100 years ago, which says that where income is sourced in one country but earned by a resident of another country, the source country primes. The source country gets to tax that, and in an effort not to double tax that income, the resident country will cede jurisdiction to tax that. So we have a worldwide system, but one that has a foreign tax credit, which is designed not to double tax and to acknowledge this compromise that says the source country should get to tax. So one way of thinking about the difference between a territorial system and a worldwide system is that in a worldwide system such as ours, reflecting this grand compromise that countries reached a century ago or so, the source country is prime. The source country has primary jurisdiction to tax, whereas in a territorial system, the source country would have exclusive jurisdiction to tax. There are, of course, hybrids in between. So now, to talk about inversions and how they fit in and give you sort of an overview before our panel goes into a deeper dive, there are generally three reasons that companies are thought to invert. The first is a desire to reduce US tax on US earnings. This is sometimes called earnings stripping. A US company that's a subsidiary of a foreign parent will find a way to make deductible payments, like interest, to a related person, thereby reducing US tax on US earnings. The main US limitation on doing that is in 163J, but it doesn't prevent it altogether in many cases. So that's the first reason, reducing US tax on US earnings, which doesn't sound like it has much to do with seeking a territorial system, because a territorial system is about not having US tax on foreign earnings. Now, the second reason that companies are often thought to invert is to eliminate US tax on cash that is held in foreign subsidiaries. There's thought to be about $2 trillion worth of cash sitting in foreign subsidiaries of US multinationals that has built up as earnings of those foreign multinationals. Further, the portion of profits that a US parented multinational earns has increased over time. That's what the blue line on that chart is showing, that the aggregate earnings over time have been more and more foreign, which wouldn't surprise you as the economy has become, as globalization has occurred over the decades. So that's the second reason, trying to get access to cash in foreign subsidiaries. The third reason that companies are thought to invert is to protect future foreign earnings from US tax. The US has one of the highest statutory tax rates in the OECD, and people don't like the idea that if a subsidiary, if a portion of their business in a foreign jurisdiction earns income, that it's eventually going to be taxed at our 35% federal rate plus state. So trying to protect future foreign earnings from US tax is a third reason companies are thought to invert, and that speaks most closely to the idea of seeking a territorial regime. That's really what a territorial regime is all about. If we had a territorial regime, it wouldn't tax foreign earnings of foreign earnings. That's the idea of a territorial regime. So how does an inversion achieve these three goals mechanically in a nutshell? Well, in a typical inversion case, the existing structure is that you have a US company with foreign subsidiaries, and it's got shareholders who may be US people, they may be foreign people. The US shareholder designation there just means they are the holders of the US company stock. And they exchange their US company stock for stock in a foreign company, in this example, a UK company. Under Section 7874, the inversion fails if the former holders of the US company own 80% or more of the combined company. But if you're underneath that 80% threshold, then the UK parent is respected as a foreign company. Otherwise, generally, it isn't, and the inversion fails. But that still leaves a lot of room for a successful inversion. Now, how do we achieve earnings stripping? How do we achieve that reduction of US tax on US earnings that people sometimes seek in an inversion? Well, the US company may distribute a note to the UK company. And your initial reaction might be, well, what about withholding tax, US withholding tax on that dividend? That can be ameliorated if there's a good treaty between the US and the parent. In the case of the treaty with the UK, if you wait a year, generally there's no withholding under the treaty on that distribution. And so what you've set up is interest deductions in the US, interest income in the UK, and that interest income in the UK may be undesirable because the UK may impose significant tax on that, so sometimes people will drop the receivable side of that note down into a Luxembourg company. The US is still getting the interest deductions, albeit subject to Section 163J. There may not be withholding tax on the interest under the US-Luxembourg treaty, and Luxembourg may not impose a lot of tax on the interest income. So that's mechanically how an inversion achieves the earnings stripping goal. In terms of accessing cash in foreign subsidiaries, as you may have heard, there was a notice that the IRS put out in September 2014-52 that really clamped down on the ability to access cash in foreign subsidiaries. But before that notice came out, the typical technique was, one of them may be simply for the CFCs, the foreign subsidiaries, to lend money to the UK parent. That's a lot more difficult and may not even be possible after the notice. In terms of protecting future foreign earnings, the way people may do that is that growth, foreign acquisitions of foreign businesses or organic growth of foreign businesses would occur where that green foreign box is, namely underneath the UK company, not underneath the US company. And potentially there may be ways of migrating the historic foreign business that's in the orange boxes over to a place that's underneath the UK company and not the US company. All right, so that's the overview. Let me now turn it over to John, who's going to talk about how inversion transactions have evolved over time and how the rules have evolved over time.
Thank you, Debbie. Our thought is that when we finally get to the causal link, or to see if there is a causal link between the reluctance of the United States to adopt a territorial system and the wave of inversion activity, it will be helpful to keep in mind a history of how we got to where we are today. So my job is to take you through the history of how the deals have evolved and how the law has responded to it. The stuff I'm going to talk about is captured in the next 9 slides, and basically you can divide them into 3 subtopics. First, I'm going to talk about efforts to tax shareholders under Section 367, then what Section 7874 does in the way of taxing the corporations that invert, and finally, I'm going to focus on some of the recent activity under Section 7874, including the notice that Debbie talked about. So let me begin with shareholder taxation, and the theme here is historical. You can think of the Book of Inversions as having an Old Testament and a New Testament. The Old Testament, we quickly forget, goes way back to 1982, and it involved an inversion of a company named McDermott. The shareholders gave up their shares in the parent company in exchange for shares of a pre-existing Panamanian subsidiary, and the government got irritated about the deal. They were probably irritated more at the company than they were at the shareholders, but they went after the shareholders and said that the stock they received in the Panamanian company was a dividend under Section 304. And the court said, no, it's not. A couple years later, Congress enacted a part of Section 1248 that, had it been in effect at the time of the deal, would have taxed McDermott itself, but it came later. That's the Old Testament. The New Testament starts about 12 years later, in 1994, with the Helen of Troy inversion. They moved to Bermuda, as I recall, with no change of shareholder ownership. The government got irked at this deal as well. They knew, though, that nothing in the current law at that point authorized taxing either the shareholders or the corporation. So they quickly issued a notice, 94-46, that said things are going to change. We'll soon issue regulations that will tax shareholders under Section 367, which they did and which we often refer to as the Helen of Troy regulations. Under these regulations, if U.S. shareholders, and I emphasize U.S. because it's different when we get to Section 7874, if U.S. shareholders end up with more than 50% of the stock of the foreign acquiring company, and in those deals it was 100%, then they're taxable on their stock gains. This turned out over the course of time to be not a very effective impediment to inversion transactions for a couple of reasons. First, there was nothing that prevented the U.S. company from downsizing prior to the transaction to enable its shareholder base to be under the 50% hurdle. More important, shareholder level gain just didn't seem to get much traction. Exempt shareholders, foreign shareholders didn't care. They weren't going to pay tax anyway. U.S. shareholders may have had to pay tax, but there was a lot of churning of shares in the market, so that by the time a deal that had been known about actually came to fruition, there wasn't that much gain left to tax. So for a variety of reasons, the shareholder level tax under Section 367 didn't amount to much. The deals kept going, and the prototypical structure involved a company organized either in Bermuda or the Cayman Islands, tax resident in Barbados by virtue of management and control there, and the significance of that is that it gave the inverted U.S. company access to the Barbados-U.S. Treaty, which meant, speaking of earning stripping, that the inverted U.S. company could borrow from its Bermuda/Barbados parent, pay interest, and there would be no withholding tax on it. So things kept rolling along, and then came a new period in history, which I'm going to call the Age of Enlightenment. Long about 9/11 time, the pace of inversion activity had picked up, and there was a lot of resentment, and 9/11 fueled the resentment. Congress said, we should do something about this. Maybe we'll enact tougher earning stripping rules. But what they gave us was Section 7874. In broad strokes, it says that if a foreign corporation acquires substantially all of either the assets or the stock of a U.S. company, and if the shareholders, regardless of whether they're U.S. or foreign, of the U.S. company end up with at least 60% ownership of the combined company, then Section 7874 will apply unless the combined group can demonstrate that it conducted substantial business activity within the country of the foreign parent. Now, a word has to be said about the level of stock ownership. If the owners of the combined entity, by virtue of their prior ownership in the domestic company, were over the 80% hurdle, as Debbie talked about earlier, tremendously bad results ensued. The foreign company was treated as a U.S. company, which meant that all of the U.S. tax planning was obliterated and that there was significant potential for multiple international taxation. So staying below 80% was absolutely mandatory in all cases. In the 60% case, there was a strange remedy in the statute. If the domestic company earned something called inversion gain at any time during the 10 years following the deal, it would have to pay a tax on that gain, write a check to the United States Treasury, even if it had otherwise available tax attributes that would have sheltered the gain. It turned out that this punishment was an acceptable punishment because many inversions that happened after that stayed between the 60 and 80% zone of ownership. Another thing that is important in this development is that along with Section 7874, Congress enacted an excise tax, 15%, imposed on stock-based compensation of the officers, directors, and significant shareholders of the target company. It turns out that in many cases, this tax has been paid by the inverted company, and the payments have been grossed up so that the employees with the stock-based compensation are made whole at a very expensive cost, which has not gone unnoticed in the ranks of shareholder activist groups. So that was Section 7874, and it slowed things down a bit, and now I want you to move forward to the last period in history, which I'll call the age of desperation. We're around 2010. It's not coincidental that by this point in time, companies had loads of cash, as has been mentioned, stored in their offshore subsidiaries and loads of earnings. And so they were desperate for a way to get the money back home, finding a merger partner sufficiently large enough so that the shareholders of the domestic company could remain under 80% was possibly a ticket to nirvana. So that's how the deals ensued. And lots of tax planning went into keeping the ownership percentage certainly below 80%, ideally below 60, but that was often hard to achieve. So between 60 and 80 was the sweet spot. To make things worse, Treasury issued regulations that made it virtually impossible for a company to demonstrate that it conducted substantial business activity in the jurisdiction of the foreign parent. It's the 25% test that you may know about. Virtually no company can satisfy it. So as we sat in 2012 when these regulations came out, the only thing that mattered under Section 7874 was the ownership percentage. Tax lawyers and other advisors got involved, expended great efforts, came up with lots of clever strategies to make sure that the ownership percentage would be diluted sufficiently to stay under 80%. Notice 2014-52 was the government's answer. I won't get into the details now, but it did essentially two things. It made it harder to avoid Section 7874 by focusing on various conditions in the acquiring company or the target company. And it said in addition to that, that if you're stuck with Section 7874, the popular forms of post-inversion planning would no longer succeed. No more hopscotch loans, no more diluting the ownership of the once CFC to below 50%, and no more attempts to extract cash out of the inverted companies controlled foreign corporations by virtue of Section 304. So now things seem to have slowed down a bit more. They certainly haven't ground to a halt, and we're waiting to see what the next shoe will be. There's proposed legislation to drop the 7874 hurdle down to 50%, and of course there's the threat of earnings stripping rules coming out of Treasury.
Willard?
Okay, so without repeating what you've already been told, although there's a little bit of overlap here, I mean, first of all, to make a point, not all of these transactions are what we would call inversions or expatriations. I mean, there are true mergers of equals in which tax may play a role in an important role in where you are, but but that's not the driver of the deal. The transactions we're really talking about, are much more 75, 25, much bigger U.S. company, smaller foreign company. There's little doubt that it's driven by tax, and I think Debbie has laid out the drivers being the buildup in foreign earnings that you can't bring back, although how important that is depends a little bit on how APB 23 applies, the future earnings, and then earnings stripping. So why do you go to the jurisdictions that seem to be predominant? There are non-tax factors that come into this, such as, there was a rumor that Switzerland might adopt proposals to cap the pay of executives. That made Switzerland rather unpopular as a choice, as you can imagine. There have been transactions in which a U.S. company and a Japanese company moved to the Netherlands, although from a tax point of view, the company was resident in the UK. Why did they do that strange thing? Because Dutch law was perceived to be more flexible in things like share buybacks than UK law. So there are non-tax considerations, certainly, that affect the choice of the country you go to. But tax is again a driver. Why do you go, for example, to Ireland, which is where a great many of the pharmas have ended up, including some companies that started out in Bermuda and then moved to Switzerland and then to Ireland. And again, they have no tax on foreign income, the 12.5% corporate tax on other income. They also, by the way, have no withholding tax on dividends paid to foreign shareholders. There is a tax on foreign earnings, but in effect, because of the very flexible foreign tax credit rules, it's not consequential. So that is a driver for the UK, the Netherlands, and for Switzerland. Now, earnings stripping, to go back to the debate subject, is this voting with your feet? If voting with your feet implies a choice between territorial and worldwide, earnings stripping is a totally different point. It really has nothing to do with that choice, and yet earnings stripping is very clearly a major driver of these transactions. And this is not new news. This is something that we've known from the very beginning. The Treasury Department in 2007 did a study of expatriations, and they concluded that the inverted corporations are shifting substantially all of their income out of the United States. So a big item, and as Paul Oosterhuis pointed out today, there are proposals to tighten the earnings stripping rules, which have very major revenue implications if you did it. So a lot of money involved. One thing that obviously has to be kept in mind in evaluating those proposals is that they would apply not only to U.S. companies that expatriated, but most of them would also apply to foreign companies with big U.S. operations, where, like Nestle's, where there's huge earnings stripping as well, and that's probably a big piece of the revenue item. We mentioned one of the earnings stripping proposals here, which was in the administration's budget a year ago. They now have a new one, but basically they're all designed to tighten 163J and limit the interest deduction. I think a legitimate question in this area is that if you if you do something about earning stripping, whether you shouldn't look beyond the interest deduction to also look at royalties and service payments, and whether that's not also an issue. So if you look at the firms that have gone abroad, and you look at their financial statements describing the transactions that they expect to take after they invert, you will come up with some marvelous euphemistic terms, like, for example, this will improve our global cash management. It will enable us to be involved in capital structure planning. What are they talking about? They're talking about taking that equity of the U.S. company and converting it into debt. They will also tell you that they're going to rationalize their foreign asset ownership. What does that mean? That means that the controlled foreign corporations will no longer be controlled foreign corporations. The proxy statements are interesting to read with that in mind. Treaties are a big piece of all of this. Debbie pointed this out when she talked about the zero withholding tax rate that you get after a year on parent subsidiary dividends in the UK. Equally important are the fact that the countries that have predominated as being the place to where companies invert have treaties which allow you to be regarded as eligible under the limitation on benefits article if you are publicly traded, not in that country, but in the United States. And that is not the model treaty. The model treaty since 2006 has always said if you're publicly traded in the United States, and that's why you get treaty benefits, then you have to have your real principal place of management control, not just the treasurer passing through from time to time, but your real day-to-day operational control in the other country. But that is not in the Irish treaty, the Swiss treaty, or the UK treaty. And certainly one question is whether in the long run treaties we shouldn't push harder to get those treaties conformed. Is all of this post-inversion planning risk-free, or is something you should be worried about? The government generally has not been very successful, and this goes back to the Nestle case years and years ago, has not been very successful in challenging intercompany debt as not being real debt. And most recently in a case not involving an inversion, but involving a leveraged purchase and restructuring of a U.S. company, which is referred to on the slide, they lost again. But they are challenging some of these structures. They are challenging Tyco, which has been split into several different companies in the interim on debt equity, and they're challenging in the tax court Ingersoll Rand. And part of the Ingersoll Rand argument is that the way in which they move the intercompany debt around from Luxembourg to here to there was treaty shopping, which is a sort of an unusual argument in terms of the way in which the treaties apply. So, Patrick.
Sure. So I'm going to try to take us to the finish line and see if we can stimulate some debate up here. So we've kind of walked through a history of inversions. John, I like some of his terms. I might describe this as kind of whack-a-mole, that inversions sort of, there's a wave and then a set of rules come out. People figure out a way to get around rules and more inversions happen. And Debbie set up what the particular benefits are. What we're going to try to do is take a step back and look at kind of a broader perspective, look at kind of a future situation where we'll explore two things, really. One is if we have U.S. tax reform, in particular, if we move from a worldwide system to some version of a territorial tax system, what would that do for inversions? And we'll try to evaluate that, not surprisingly, by looking at what are the reasons why people are inverting, how much does that change in a territorial tax system. The other thing that we're going to try to take a look at is, I'll call it global tax reform, BEPS. How does activity in BEPS, how does that impact whether U.S. multinationals continue with inversions? So Debbie already kind of set out the basics of a territorial tax system. Some amount of it, it focuses on foreign earnings, although I will say that to the extent that you're focused on foreign earnings and giving someone an exemption, your U.S. tax base becomes that much more important. So if you're giving folks a break on foreign earnings, you have to be that much more careful about not allowing excess leverage in the U.S. In terms of trying to have some system that we can have some further discussion around, we thought maybe it was useful to give really just the basics of the Camp proposal, because I know there's subsequent panels that are going to get into the Camp proposal in a lot of detail. So again, I said, think about territorial system like the Camp proposal through the lens of what the benefits are for an inversion. So first question is, what would a territorial system do for future foreign earnings? And so the Camp proposal really kind of has roughly 3 buckets of income. It's got active foreign earnings, it's got IP related profits, and then it's got passive, highly mobile income. Think about it in those rough strokes of 3 categories. With respect to the active earnings, you get to the point where with a 95% DRD, that you're looking at a 1 1/4. This is also assuming that the corporate rate goes from 35% down to 25%. But you're looking at, with respect to active foreign earnings, a 1 1/4% tax on those earnings. That seems pretty good. I think we'll have to evaluate whether other territorial systems might be better, but we'll come back to that. But if you look at what the Camp proposal does with IP-related income or other passive income, then as compared with, and I am getting a bit ahead of myself, but with respect to IP income, when you kind of sort through and don't worry about how it's being phased in, essentially you're getting to IP-related income being subject to a minimum tax of 15%. So, obviously better than the 35% that could apply in a worldwide system, but 15% is still a pretty high rate. And then the last category is passive income, which continues to be subject to a Subpart F regime with 960 credits, and again, with a corporate rate at 25%, you've got a maximum rate of 25% on passive income. So that's sort of your future foreign earnings picture. We talked about how access to foreign cash is another big driver for inversion. So what about this, the so-called $2 trillion of offshore cash? How does that play into moving to a territorial system? Well, the Camp proposal proposes to have effectively a mandatory repatriation of those earnings that does get a reduced rate, but it splits it into sort of 2 categories, and this is all based off of the 35% rate. The notion is you have this mandatory repatriation before you move to a territorial tax system, and you sort of split between 8 3/4% on sort of cash that's coming back. To the extent that you're talking about non-cash offshore earnings, then you can get down to a 3.5% tax. So that's where we are with existing earnings. And then the last piece, which I agree a territorial system speaks to foreign earnings, but with respect to the Camp proposal, not only U.S. multinationals that would continue to be U.S. parented companies, there's a focus on excessive leverage and sort of a thin cap notion to limit how much leverage a U.S. multinational could take on, but also there's revisions proposed to 163J as well, which don't necessarily go with territorial by itself, but there's tighter standards for inverted companies as well, or companies that would consider inverting. So that's kind of where we are in the territorial system. So maybe we'll quickly touch on BEPS, and then we'll get to that debate. So U.S. tax reform, or at least a territorial system that is focused on what the U.S. tax system would do with respect to foreign earnings. Now we'll shift our focus, and obviously BEPS is, the U.S. is part of BEPS as well, but we might think of BEPS as more focused on what are non-U.S. jurisdictions doing in terms of some of the strategies that are available to reduce the non-U.S. tax with respect to foreign earnings. And so I suspect I didn't hear the prior panel, but the BEPS initiative, there's 15 action plans. We are here just kind of focusing on 3 aspects that seem particularly relevant to the inversion debate. One is what happens with respect to related party financing. And to date, some of the focus would be on certain hybrid arrangements that ultimately lead to related party financing where there's no or relatively little tax paid on the interest income. As we talked about, this is more focused on the U.S. source, but to the extent that you're currently not picking up local tax on interest income, if you were to increase that, might make conversions less appealing. The other aspects, transfer pricing and IP, Debbie talked a little bit about out from under planning that usually goes along with an inversion. Part of inversions that's attractive is placing IP, and in particular the profits of IP, in a low tax jurisdiction. Again, if that dynamic changes, might make inversions less attractive. And maybe the third category, which Willard alluded to, is treaties. Certainly from U.S. source payments, treaties make inversions very attractive. To the extent that we're talking about foreign base eroding payments, treaties become relevant there as well to ensure there's no U.S. source, or there's no foreign source withholding on those payments. So maybe with that as some background, we can start debating.
Sure. So to start that discussion, one question I would have for the panel is, if we did switch to some version of a territorial system, do you think we would still see inversions occurring?
Well, I'll try a stab at that. I think the answer is we don't know. It's a bit like dating. You're with somebody, and maybe somebody else looks a little better, but you can't really decide whether to leave partner 1 until you know who partner 2 is like. So we might adopt an exemption system, and the systems in other countries might still look a lot better, and depending what we would do to curtail earning stripping, you might see a continued wave of inversions. I think it's impossible to know because it's a comparative judgment. What's the system here? What's the system someplace else? And until you have all of those inputs, I think it makes for interesting newspaper reading, but not really a very intelligent way to go about analyzing should we or should we not adopt the territorial system.
And John, I know you sort of slipped it because the focus is, okay, what's happening with respect to foreign earnings, what system would be better, and I know you slipped in, well, assuming that they did something with respect to earnings stripping. If you didn't do anything with respect to earnings stripping, then one would think that territorial system wouldn't do much to slow down inversions at all if you can still erode your U.S. tax base.
Right.
Yeah, and I think it's probably distortive to view the question of should we have a territorial system or not based solely on inversions. I mean, it's a much bigger issue, and it shouldn't be driven by inversions alone. So.
What else do you think should be a factor?
Well, you've got, you know, the whole tax system has to be looked at, including inward investment and outward investment, but it shouldn't be simply an anti-inversion proposal.
Sure.
That's my only point.
I mean, I suppose if you had a pure territorial system, then with at least one caveat, it might not matter if a company inverted, because either way their U.S. source income would be taxed in the U.S., regardless of whether they're a U.S. resident or a foreign resident. The one caveat, I suppose, is that the way in which there may be earning stripping opportunities if you're foreign that wouldn't be available if you're still U.S. parented. The nature of how U.S. income would be taxed might be different depending on your residency, although that too depends on how BEPS works out here, how much we do to shore up earning stripping, and by the same token, BEPS could impact the attractiveness of the potential host country where a company might go. So, you know, the concept of voting with your feet, as I mentioned at the beginning, suggests that the scenario is that the U.S. is in a competitive environment. All these different countries are sort of vying for businesses. And that, you know, when you say, gee, people are going to vote with their feet, what that sort of says to the people, the institution that they're voting on, is you better listen to that, and there's sort of a race, could become a race to the bottom, and you got to kind of align with the other, the U.S., in this instance, have to kind of align with the other competitors, otherwise you're going to...
Yeah, but isn't voting with your feet just a PR statement? I mean, it's just a way of, it came out in the beginning of, you know, oh, we're fed up, Congress is constipated, so we have nothing to do, we're perfectly honorable, patriotic people, but it's just so frustrating to have to deal with this Congress. I'm not saying that inversions are evil or bad or anything like that, but I always thought that voting with your feet was just a way of glossing over, you know, what's really involved in...
Of glossing over the idea that...
Certainly glossing over earnings stripping, completely glossing over earnings stripping. And also presenting, and also for companies that were concerned that people would say you're committing some sort of unpatriotic sin, which was part of the debate, you know, for the last 10 years, as somebody pointed out in 9/11 and all, was a way of deflecting that criticism.
Yeah, so, you know, so getting to that, what I think you're getting at, you know, the U.S. has done a phenomenal job of fostering businesses over several centuries. I mean, I think most people would agree there's something about the social, economic, cultural, legal, political environment here that really has allowed businesses to flourish in the big picture. And people also might think that people should pay for what they get, that businesses that most benefit from that should pay for it. And one could further argue that a worldwide system of taxation, even one with deferral that cedes taxing jurisdiction to a source country, that arguably that type of system best allocates the tax burden to businesses that enjoy the advantages of being here, that worldwide income is a proxy for how much benefit you get from being in the US. And one could further argue that a territorial system doesn't address that allocation, fairness of sharing the tax burden as well. What do you think of that? Is that a part of this debate, or is it all about just keeping up with the other countries in terms of tax competitiveness?
Well, I think the subtext behind the argument that we better adopt territorial to stop the wave of inversions, if you unpack it, is that we better give up residence-based taxation, because if we don't, we're going to lose residence-based taxation. It's kind of circular. To put it more crudely, we better race to the bottom along with somebody else. I think the one persuasive thing that can be said about the argument in favor of territorial taxation, the one of many things can be said in favor of it, is that if the present trend does continue, forgetting about the tax base altogether, if we do lose white-collar R&D type jobs just because, for good or bad, companies decide to move offshore, that's obviously not a good thing.
Mm-hmm. Other thoughts on this allocating the bird? Does territorial system
That was very well put.
do a good job? So does that,
Well, the strange thing is that when people say it, they don't realize how silly it is.
Right.
so where does that leave you? Do you think that?
If I were king, I would just sit and wait and see how BEPS unplays. I don't
You have
know
to have
what.
a long life.
Maybe so.
You know, I mean, no, seriously, because
Looking for retirement
you know,
there, John.
look, I mean, when do you think we can't even? When was the last treaty the U.S. ratified? 5 years ago, and we're talking about maybe BEPS treaty will solve the problem. I mean, good gosh.
Well, I just don't think you can know what's intelligent to do right now until you have a better understanding of what's going to happen in other countries. So
Well,
I wouldn't do anything quick-like just to stop inversions. I think that notice did a lot of damage. Certainly if they come out with something that makes it more difficult to deduct outbound interest, that will do more damage. And I would stay in a holding pattern until things clear up a bit.
So you'd keep with these stopgap measures as best one could, see how things came out, and then make a...
Until it became clearer what the intelligent response was.
Right, and the one other factor that maybe plays in here, there's this government contractor issue, which the government contract issue, as I understand it, basically followed 78, 74, which is to say if you're not inverted for that purpose, you're not inverted for purposes of government contracts, which means that if you move to the Bahamas and then move to Switzerland, you're not an inverted company now because you didn't move from the United States. I mean, so there are other measures that could have a big impact on inversions that don't have anything to do with tax, like reforming that.
At least in some industries. That
In some
wouldn't
industries,
affect
but,
other industries.
Yeah, in some industries, but you know, pharmaceuticals is certainly.
Well, what do you, Willard, you mentioned that you didn't think inversions should drive the tax reform debate. Do you think they're just sort of a fad and we shouldn't pay much attention to them, or are they more like the tip of the iceberg, you know, to use many metaphors? We've got all sorts of metaphors going here. You know, the canary in the coal mine telling us that there is really a big problem, or are they just sort of a kind of a thing that's off, not too significant in terms of the debate?
Well, I think that, you know, I think the debate on what kind of tax system we have, which involves a whole bunch of things other than worldwide versus territorial, involves corporate versus pass-through, and lots of other things, ought to be a broader subject. And we shouldn't say, well, we have to move to territorial just because of inversions. You know, it ought to be only one piece of it. You know, it's certainly, from a practitioner's point of view, it's one of the most fascinating aspects of the international tax system. But, you know, if you were making policy, that's different.
Pat, you started to talk about BEPS and its impact on inversions. And did you want to explain how you thought things could conceivably play out? John had talked about waiting and seeing what the big picture is, and I think you had a thought about one possible path that
this
could go down.
This is a straw man to be challenged for sure. But one scenario just to throw darts at would be, BEPS, really gets some traction. You get local countries adopting various BEPS inspired measures, and as a consequence, there's less foreign base erosion. Does that mean that now our foreign parented companies now look for opportunities to acquire U.S. companies? I'll call it real M&A transactions, but they see an opportunity to erode the U.S. tax base. All of this is presuming we haven't done anything to limit U.S. earnings stripping. Now we have U.S. multinationals that are worried about being gobbled up, maybe having a competitive disadvantage when it comes to M&A transactions. So they, obviously living within the rules, try to do kind of their self-help inversions, still real M&A transactions, but maybe looking for foreign targets to combine with to satisfy 78, 74. So then we get to the point, which we've seen this through history, we get lots and lots of political pressure, U.S. companies leaving, and there's a wave, and so we get some modest, let's say, tax reform, but we don't get either. We look at it somewhat cynically and say, well, even getting tax reform really wasn't part of why people were inverting anyways. It's not enough, and so we still have inversions. And then we're sort of back to where, then the theory would be, we'll just be back to where we are today, which is, how do there's a twin approach to limiting through stopgap measures. One, I make them less attractive. A lot of that aspect is in the notice. And I come up with stricter rules that prevent U.S. multinationals from inverting. So that's kind of one scenario that says, even though BEPS doesn't seem like it should be impacting inversions, because it's not about arguably it's not about how U.S. taxes foreign earnings or U.S. earnings, but you can see how it could have an impact on inversions.
So you're saying if other countries enact BEPS-type measures and thereby protect their own source income, but we don't do anything because we're kind of gridlocked, that's going to encourage inversions because the one base left to erode is the U.S. tax base. That'll put more pressure on because you'll see an even bigger wave of inversions. And that might, in turn, finally cause Congress to do something which might be just further stopgap measures or could be including limitations on earnings stripping. I mean, John, do you have any, given that you said, hey, let's kind of wait and see what makes sense, do you have any reaction to that? I don't mean to put you on the spot, but.
No immediate strong reaction to that. It does, I mean, we're into the realm of the political now, and probably no one in this room is capable of predicting such a treacherous subject. But I do find it unlikely, no matter how bad our Congress is, there has to be some bottom. If the rest of the world, or most of the rest of the world, does follow the lead that the BEPS project is taking, I just don't see the United States sitting on the sidelines.
Mm-hmm. Okay, are there questions from the audience? There's got to be somebody with a question.
Here's one.
Is there one? Oh.
Have there been any studies about what the actual impact of employment has been on these companies that have inverted? I mean, the U.S. is still the biggest market in the world, and people are still doing business here. And once a company inverts, not all of its employees leave. How has it impacted all of these companies that have actually inverted?
I don't think there have been any real studies of that. I think there's been more studies of the impact of the lockout effect, which is related to this, obviously, on corporate behavior and the incentive it gives them to make foreign rather than domestic acquisitions. But I'm not aware of any studies that have counted the number of heads that have moved, that would not have moved had you not inverted.
There's anecdotal information when executives of pharmaceutical companies have been asked about the extent of operations that are going to go to wherever the companies have inverted to. The usual response, and I'm not making this up, is we love New Jersey.
Yeah, we're still, or Ohio, we're still in, yeah, exactly.
I mean, that said, I think there are jurisdictions like Ireland, for instance, that, that have gotten employment because of inversions to the local jurisdiction. I mean, there are
Well,
scenarios.
their tax system is a great source of employment, whether or not you're talking about inversions, but
there may be some migration, or some notion that companies do put employees in the local jurisdiction.
Well, I think that that's more
Sometimes.
a reflection of the CFCs, but not necessarily inversions.
I mean, yeah, it could be both.
Yeah, because remember, what we're talking about for the most part, at least initially, is we're just talking about the parent company. And the parent company is, typically a holding company. Yeah, maybe some executives, move to the UK or Ireland, but we're just talking about executives. Then the question is, do you follow that up by changing your operating company structure? And then the question is, do you now, either want to or need to move those folks? And I think to date, for the most part, I'm not sure that people have felt the need to move those people.
Well, one other quick question. This whole discussion started with the U.S. rate being 35%, but nobody really talked about the effective
Of
rate
course,
of
yeah.
all of these companies, which is much, much lower.
Absolutely, yeah.
Okay. One quick question.
You spoke about the 2014 notice. I was just curious if people had a sense of whether the administration thought that was a success, and if there's more to come there on the regulatory front if there's no legislation pending.
My sense is they're interested in finding out if it's a success by asking around. I don't think they know. I don't know what you've heard, but they're curious about that. And on the question of whether there's more coming, I mean, nobody knows. They keep saying they're thinking about earnings stripping, but nobody really knows.
Right.
Okay,
Yeah.
well, thank you, Debbie and Pat and John and Willard. It's now time for us to vote with our feet by walking across the hall to Greenberg Lounge for buffet lunch. Please make sure to be back at 1 o'clock for the keynote speech. Thank you very much.